Assalamualaikum warahmatullahi wabarakatuh. Hi everyone. So in this last video, I will tell you about international financial reporting. But before I start, let me introduce myself. I'm Jenny Sagisa Putri with student number 2341171 from class Management 2023. So the first thing I will explain is the introduction of financial reporting. Financial reporting in an international context involves preparing and presenting financial statements for companies that operate across multiple countries. These firms must follow global standards such as IFRS while also complying with local accounting rules in each region. Differences in regulations, currencies, and business environments create challenge for consistency and transparency. Understanding international financial reporting allows companies to communicate reliable information to global investors, regulators, and stakeholders. And then, the second thing I will explain is international financial statements. International financial statements include the income statements, balance sheet, and statement of change in equity prepared for multinational operations. These statements must reflect economic activities conducted in different currencies and adapt to diverse accounting practices. Companies often face subsidiaries that use different standards. Proper international financial reporting ensures that financial performance is accurately represented and comparable across global market. And then, translation of foreign currency financial statements. When multinational companies operate abroad, their foreign subsidiaries prepare financial statements in local currencies, which must be translated into the parent company reporting currency. This explanation involves converting asset, liabilities, income, and expenses using appropriate exchange rate based on global accounting standards. Currency fluctuation can significantly affect reported earnings and financial positions, creating translation gains or losses. Accurate translation is essential to maintaining consistency and reliability in consolidated international financial report. And then international cash flow management. International cash flow management focuses on controlling and optimizing cash movements across countries and currencies. Multinational firms must coordinate cash inflows from sales, investment, and financing activities with outflows such as payments, production costs, and tax in different regions. Currency volatility, transfer restrictions, and banking regulation often complicate cash flow planning. Effective cash flow management helps companies maintain liquidity, minimize costs, and supports smooth global operations. And next slide is cash repatriation and transfer pricing. Cash repatriation refers to the process of bridging profits earned abroad back to the parent company. This process is influenced by local laws, tax policies, and foreign exchange contracts that may limit or increase the cost of repatriation. In addition, multinational firms use transfer pricing to determine internal prices for goods, services, or assets exchanged between subsidiaries. Managing transfer pricing and repatriation carefully helps companies reduce tax burden and ensure efficient internal financial flows across borders. And then, international taxation and compliance. International taxation involves understanding and complying with tax regulation in every country where a firm operates. Companies must navigate differences in corporate tax rates, tax incentives, withholding tax, and double taxation rules. Many countries have tax rates to prevent firms from being taxed twice or the same income. But compliance still requires careful planning and documentation. Effective international tax management helps companies reduce tax risks, avoid penalties, and optimize global profitability. And in conclusion, is financial reporting, cash flow management, and taxation in an international context are essential components 4. Ensuring that multinational operations run effectively and transparently. Companies must prepare accurate financial statements that comply with global and local standards, manage currency translation, and maintain efficient cross-border cash flow despite regulatory and economic differences. At the same time, they must comply with complex international tax rules to avoid legal risks and optimize global profitability. Mastery of these areas strengthens a company's financial stability, enhances decision-making, and supports sustainable growth in a highly competitive global business environment. I think that's all that I can explain about this material. Thank you. Wassalamualaikum warahmatullahi wabarakatuh.